Hi guys, welcome to my channel. Today we are going to be answering discussion questions. Obviously, I'm Stabile Mbonambi and I am the person who's going to be walking you through how to answer discussion questions. I know discussion questions are an issue, so I'm going to illustrate through this very short tutorial how I would structure my questions. So I answer all my questions using something called the PAC approach. If you are in your undergrad studies, this would be the IPAC approach for you. So let me first explain what PAC is, and then I'll explain what IPAC is. So PAC stands for Principle, Application, Conclusion. This means that in your fourth or third year of studies, you will not be required to identify I, which is the issue. In first or second year, you're probably going to be asked to tell me what standards a certain section appears in. However, in other modules or in other courses, as you go higher and higher up the academic ladder, you're not going to be asked. It's assumed knowledge. So if I give you machinery, I'm not going to give you a mark for stating it's IAS 16. If I give you trading stock, I'm not going to give you a mark for stating that it's IAS 2. However, the mark is going to come into knowing exactly which parts to extract of IAS 2 or IAS 16, apply for those two standards. And the most important part that I've seen when I'm marking is that so many people leave me with a, okay, so what type of response to me as a marker. Because if you are marking a script and someone's not concluding, you cannot give them the mark because it simply is not there. So always conclude, and I'm going to show you exactly how to illustrate that you have concluded. What does our discussion question even look like? So in this situation, we have WhatsApp Limited, which has 1,000 listed shares in Wasdown Limited, a company listed on the JSE. These shares are more frequently traded on the JSE than in any other market. The shares were trading at R2.50 per share on the JSE on 30 June 2010. These shares can be sold off market at R2.55 per share, and the directors are unsure which value should be used as the fair value. Here's our required. Advise the directors in terms of IFRS 13 of the above mentioned issues. Do not discuss the complete definition of fair value. Only focus on the relevant aspects of the definition. So do you see what I was saying? The whole principle part is how you are able to extract the relevant definitions of the standard. So let's look at what this looks like. So I would expect you to go back 10 seconds and pause on the last slide just to see if you would answer it in a similar fashion. So I'm going to break it down in terms of principle, application, and conclusion, as I did say. The principle, and I have noted here, this is where you show off your theory knowledge. You speak about what the standards say you need to do. Don't quote the standard, because I've seen a lot of students give 5 lines based on the standard, and the principle is normally 1 or 2 marks. The application carries the bulk of the marks, then the conclusion, but the principle doesn't carry that many marks. So use a general understanding or general terms in the standard that are in the context of the question given. Otherwise, you're going to waste time if you focus on writing out the standards. So here's my definition. IFRS 13 states that an entity determines the fair value measurement in the principal market of an asset or liability. The principal market is the market with the greatest volume and level of activity, and in the absence of a principal market, the entity determines the fair value in the most advantageous market. So this is a 4-mark question, so I wasn't going in deep, but now I have to go into my application. Application is where you differentiate yourself and show your examiner that you actually read the scenario provided and didn't just spew out textbook information. because the principal market exists. See, the JSE, I'm linking the term that was used in the scenario. The JSE is the place where shares are most frequently traded. IFRS 13 does not allow the use of the most advantageous market. So remember with IFRS 13 states that you can only use the most advantageous market in the absence of a principal market. So the whole thing that they're testing here is that, do you know how much should be traded at which market? And which market becomes then the determiner of our fair value. Although the shares can be traded at R2.55, see, I should have put off market. Oh, I did. The off market shares sold. Although they can be traded at R2.55, this is not the principal market. See, I'm giving the figures to show everyone that I know what I learned. I'm giving numbers. I'm giving the JSE. I'm giving the context that was given in the scenario just to show that I did read the scenario and I'm applying directly what is being taught to me. How do we then conclude? Therefore, which can be the opening statement for your conclusion, the principal market must be used and the shares of R2.50 will be used to determine fair value. Easy peasy? Let's do a 4-mark one together. So again, Was Up Limited purchased a beachfront property during the current year. The property was bought from Mr. Aish. The property was $2,500,000, which is R1 million below the value the bank valued the property at when granting the loan. The directors are unsure which value represents fair value. They further noted Mr. Aish was declared bankrupt shortly after the sale. So once again, just pause the video here. Pause the video here in order for us to just attempt it on our own and then come back and look at the answers. That's how you learn. We have the same required. Advise the directors on the above mentioned issues and don't discuss the complete definition of fair value. So before I go to that answer slide, I just want to show you what I said IFRS 13 fair value measurement is on this slide and what I said it is on the next slide. Do you see that I have changed what IFRS 13 components I use? So the one before was focusing on the principal versus the most advantageous market, whereas this one is focused more on what price is sold, what price the asset is sold at, and what price the asset is received at being the fair value. So I did say IFRS 13 states that the fair value of an asset is the price that would be received to sell the asset. Fair value at initial recognition does not always represent the transaction price, and conditions listed include transactions that take place under duress or when the seller is forced to accept the transaction price. Please look at paragraph B4 of IFRS 13. I did not put this here as my answer. That's why it's highlighted. I put this here so that when you go through your notes, you're able to carry on and see how my work relates to the standards. Because otherwise, you're not learning anything from here. If you can't take away just a new paragraph reference, there's nothing new I have taught. Now, I've put back the same slide openness on application by saying this is where you differentiate yourself. Although the transaction price is $2,500,000, this is R1 million below the value the bank valued the property at. We were told this in the scenario. So Mr. Aish was declared bankrupt, which indicates he was forced to accept the transaction price. Why do these words matter? Because they're identical to this. Or when the seller is forced to accept the transaction price. Mr. Aish was forced to accept the transaction price, which is not indicative of the fair value. So now we go to our conclusion and we say, therefore, the $2,500,000 transaction price does not represent the fair value as Mr. Aish was not a willing seller. The 3,500,000 represents the fair value of this transaction. So this is the actual solution per the textbook, but I think you should look at this and understand how, pause, look at this, understand how I got to my answer and how this answer came about. So I'm now going to do a discussion question based on the ITC 2024 January exam. So this is an acquisition, and in doing an acquisition, they did a due diligence report on Dent Out. But so CorpTrue conducted a background search on Dent Out, and there were several reviews on Google and Hello Peter. Hello Peter is that site where people go to post their honest reviews of companies, that stated previous Dent Out clients had claimed that Dent Out fit reconditioned parts, so they took used parts for vehicles and charged the customers for new parts. The reviews state that Marcelo refused to acknowledge their claims and they were going to follow a legal route. No lawsuits have arisen from these allegations at the date of this report. CorpTrue met with the RVR in-house legal team to discuss these allegations and the claim from the Mondi family. They informed CorpTrue that after a detailed internal review of vehicle repair and job card reports, it appears more likely than not that some instances exist where reconditioned parts were used by the repair technicians. However, the legal team stated that the possibility of legal action to be successful is remote. Then the legal team also estimates claims to be 900,000 Rand, estimates claims to be 2,500,000, and the legal fees to be 900,000 Rand. So that is it. That's the only excerpt I'm giving you from this question. I just need you to read the required and give me the answer. Discuss the appropriate accounting treatment arising from the faulty reconditioned spare parts in Note 1 in the due diligence report of the separate financial statements. So we're just going to do the separate financial statements. The at acquisition consolidated financial statements, you can look through the scenario, you can go through it on your own, but today we're just going to be doing the first one. So here's how I took the scenario and I got my 8 marks. Firstly, I had to ground us to the right paragraph and to the right standard. And I said that the accounting considerations must be assessed in terms of IAS 37. So IAS 37 speaks about provisions, contingent liabilities, contingent assets. Would you mention a contingent asset in this respect? No, because it's not relevant to this thing. So that's what the principal element is trying to teach you. Extract the theory, do not theory dump, but extract the theory that is most relevant to whatever it is you are doing. So here, there could be a provision, there could be a contingent liability. How would I have understood that? There is a lawsuit. Lawsuits can either be something you have to provide for and recognize a provision for, or something you'd have to disclose a contingent liability for, because we do not recognize contingent liabilities. So I then went on to just merely state what the definition of a contingent liability is and what the definition of a provision is. So now what I'm not expecting from you to do is to put the 0.14.10a. I did it for your benefit. I did it so that when you go back and you do this question, you can go back into the solution and say, oh, that's where that comes from. So in this scenario, one needs to consider whether the allegations from the Mondi family create a past obligating event. With respect to Dent Out, this lawsuit, see, the lawsuit is something I found out about in the scenario. Mondi is a family I found out about in the scenario, so I'm linking the things. The lawsuit may indicate the presence of a present obligation. Because the repair records show that some reconditioned parts were sold as new parts, which is what the lawsuit relates to, it can be concluded that there is a deemed present obligation that Denthout has. So now you're looking at each element here. Remember, you need to assess whether there's a present obligation as a result of a past event. So that's what we looked at here. Now you need to see if there's a probable outflow and a reliable estimate. I spoke about the probable outflow being remote per the legal team, and therefore it's not probable that an outflow of resources is required to settle the legal obligation. Is it a reliable estimate? The amount of the obligation can be reliably measured, as the lawyers quantified $2,500,000 in claims and $900,000 in legal fees. So what do you think based on all this information above? Therefore, although the amount can be reliably measured, the probability of a present obligation resulting from past events, a present obligation from a past event leading to the outflow of economic benefits is remote. So it doesn't meet the criteria of a provision in terms of IAS 37.14. Therefore, no provision must be recognized, and as this is a possible obligation and does not meet the recognition criteria. Here, no contingent liability can also be disclosed. Why? Because the possibility of the claims is remote. So I just want to go to my final thoughts and basically just summarize this whole lesson and say, principle, always state what the standard says, removing only the valid points of that standard. Do not regurgitate everything the standard says, just the parts in the question you are being asked. Application. Show your examiner that you are applying using some of the following keywords. In this scenario, blah, blah, blah happened. Because the fair value was blah, 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 blah. Although the fair value was used to measure, you carry on. And as a conclusion, you can also say, as a result, therefore, and in conclusion. And in conclusion of this video, I just want to say thank you, everyone, and I hope that this was quite helpful, and have a lovely day. Bye.